Just a couple of weeks ago, you could open an app on your phone and bet on the value of OpenAI, a company worth $1.34 trillion, a company that has never once traded on a public market. You could buy exposure to it anyway, synthetic, on-chain, and in seconds. But then it died. On June 15th, that one app settled every position, handed everyone their money back, and walked away. And I'd argue the story of why it died is the single most important thing happening in crypto right now. Because the headlines want to sell us a gold rush, a permissionless explosion, new markets, new venues, infinite possibilities, but that is not what is happening. What is happening is a purge, and most people are looking in the completely wrong place. So today, I'm going to show you exactly what's going on. First, I'll break down the mechanism that made these markets possible, then expose why a venue doing over $500 million in volume still could not survive, and finally, and most importantly, I'll show you where all the flow is consolidating and who captures it. My name is DC and you're watching the Coin Bureau. Now, before we get started, you need the bigger picture because timing matters. Bitcoin is sitting at around $63,000 to the time of this recording, well off its highs. And the broader market has been choppy and risk-off for most of this year. And yet, against that backdrop, one token has gone absolutely vertical. Hype. The token behind Hyperliquid is up roughly 173% year to date. It started 2026 around $24 and printed an all-time high of $74.47 back on June 3rd. That's a $22.5 billion market cap built while most of crypto was bleeding sideways. So the obvious question is, why is this one thing ripping while everything else stalls? And the answer starts with an upgrade called HIP-3. HIP-3 went live on Hyperliquid's mainnet on October 13th, 2025. And here's what it actually did. It made perpetual futures markets permissionless. For those unfamiliar, a perpetual or a perp is just a derivative that lets you bet on the price of something with no expiry date. And before HIP-3, only the core team decided which perps got listed. After HIP-3, anyone could deploy their own venue on Hyperliquid's matching engine without asking permission from anyone. But, and this is the crucial bit, anyone comes with a price tag. To launch a venue, you have to stake 500,000 Hype tokens, and at today's price, that's roughly $33 million locked up. But it gets even sharper because if validators decide you've manipulated liquidity or botched your oracle, they can slash anywhere from 20 to 100% of that stake. So think of it as a very, very strict filter. It's a $33 million bet that you can actually pull real traders to your venue, and if you can't, you bleed out slowly while the costs eat you alive. The builder keeps 50% of the trading fees the venue generates, the protocol takes the other half, and to keep that revenue neutral, HIP-3 markets charge double the standard fees. So you're paying premium rates and fronting 8 figures. And the first big name it killed is the one I opened with. Now, before we dig into the purge, a quick word. The market moves fast, and keeping up with both crypto and the wider macro picture is genuinely a full-time job. If that sounds daunting, or you simply don't have 16 hours a day to sit glued to a screen, we've made it a lot easier. Right here on YouTube, you can now access the new Coin Bureau Club Lite plan. For just $10 a month, you'll get daily market updates across both crypto and TradFi. Our teams read on the best opportunities and curated updates with only the bits that actually matter. Just tap the join button below this video to get started. Right, back to it. So let's talk about Venturals, because this is what should make every builder in the space nervous. Venturals was a HIP-3 venue with a genuinely clever pitch. It let retail traders get synthetic exposure to private companies that aren't listed anywhere. And its flagship products were perps on OpenAI and Anthropic. When it wound down, it settled those markets using a TWAP, a 24-hour time-weighted average price, basically averaging the price over a full day so nobody could manipulate the close in the final seconds. The OpenAI market settled at an implied valuation of $1.34 trillion. Anthropic settled at $1.62 trillion. V-Hype holders got refunded 1-to-1 plus their accrued staking yield. No token was ever issued, no exit scam, nothing nasty. A clean, orderly death. And here's the crazy stat. Venturals did around $650 million in lifetime trading volume. It attracted over 500,000 Hype in community deposits. Real people put real money through this highly active venue, but it still couldn't survive because of one major reason. Venturals relied heavily on internal quotes and self-referencing price feeds. So in plain terms, it was largely making up its own prices for assets that don't trade publicly. And that creates a structural weakness, a venue that's fragile to oracle failure and manipulation, and one that struggles to build the deep liquidity serious traders demand. The team said they were joining another project inside the Hyperliquid ecosystem, which is a polite way of saying the venue wasn't worth keeping alive. And that brings us directly to the venue that ate everyone's lunch. While Ventuals was settling its positions, one venue was busy swallowing the entire ecosystem: Trade XYZ. As of mid-June 2026, Trade XYZ commands roughly 97% of HIP3 volume, so basically all of it. It has processed over $100 billion in volume since HIP3 launched back in October, and its flagship moment is a thing of beauty for understanding why it won. Trade XYZ listed a perp on SpaceX, ticker SPCX, on May 18th. In the weeks before SpaceX's Nasdaq debut, that perp was trading at a premium to the $135 IPO reference price, giving traders genuine pre-IPO price discovery that traditional markets simply can't offer. Then on June 12th, the day of the actual IPO, the SpaceX perp did between $1.3 and $1.4 billion in volume in a single session, on one day with just one product. And right after that spike, Hype itself jumped around 12%. That's the fee revenue flowing straight back to the token, which is super important, and I'll come back to that in a second. So Trade XYZ won because it used clear anchor prices from public markets wherever it could, rather than making numbers up. It built deeper liquidity, which means tighter spreads, which means more credible price discovery, which pulls in more traders, which deepens liquidity again. And to underline how serious this got, in March 2026, S&P Dow Jones Indices officially licensed the S&P 500 to Trade XYZ for a perpetual contract. A legacy index giant formally licensing its crown jewel to a permissionless DeFi venue. That actually happened. So here's the bigger pattern, the layer underneath all of this. HIP3 ultimately triggered a process of brutal natural selection. Think of it as Metcalfe's law applied to liquidity. The value of a trading venue is exponential to the number of people using it, so an early liquidity lead doesn't just compound, it becomes almost impossible to overturn. Ventual's $650 million wasn't enough. Trade XYZ's $100 billion was the black hole. And this is exactly where crypto is heading. It's the same story that played out with Uniswap in spot trading and the lending protocols before it. Redundant apps die. The venues with real flow survive and devour everything around them. Permissionless at the infrastructure level does not mean decentralized at the liquidity level. And that distinction is the whole game, which brings us to why Hype specifically benefits, because the venue captures the flow, but the token captures the venue. Here's the mechanic. Hyperliquid routes somewhere between 97 and 99% of all trading fees into something called the Assistance Fund. And the Assistance Fund does one thing. It buys Hype on the open market and effectively burns it, removing it from circulation forever. This isn't a promise some founder can quietly walk back. A governance vote in December 2025 locked it in, with around 85% of validators agreeing to treat those holdings as permanently burned. The scale here is genuinely hard to overstate. Cumulative Hype buybacks have now surpassed $1.3 billion. And because those tokens were bought at earlier, lower prices, the Assistance Fund's holdings are now worth close to $2 billion at today's prices. Analysts peg the annualized buyback intensity at roughly 7% of market cap, which is 4 to 5 times higher than Ethereum's or BNB's comparable burn rates. Hyperliquid commands around 70% of all on-chain perpetual volume across every blockchain. So now picture the full flywheel. Flow consolidates to the venue with real liquidity. That venue routes its fees into buying and burning the token. The token rips, which funds more development and pulls in more builders, which pulls in more flow.
Right, if you're looking to trade these latest market moves, whether that's crypto or traditional assets like gold and commodities, then BitGet is definitely worth a look. They've just rolled out their TradFi trading platform, which lets you trade assets like gold and other commodities directly using USDT, so you don't need to jump between platforms. You also get deep liquidity, low slippage, and access to up to 500x leverage. Now, if you sign up using the QR code on screen or the link in the description, you can get up to $50,000 in bonuses. And on top of that, if you complete your first net deposit of $5,000 and place your first trade, you'll unlock a VIP 3 trial. Now that includes up to 38% fee discounts, exclusive VIP perks, and free token airdrops. So scan the QR code, check the link below, and see what BitGet has to offer.
And that, ladies and gentlemen, is exactly why Hype is up 173% in a down market. But now I have to be straight with you because if I stopped here, I'd be selling you a fairy tale. Don't get me wrong, Hype is amazing, but every single thing I just praised can also be a risk. Let's start with the obvious one. That 97% figure that makes trade XYZ look unstoppable is also a single point of failure. If trade XYZ's oracle breaks, if its team makes one catastrophic mistake, or if a regulator decides to target it specifically, the entire HIP3 value proposition collapses with it. Concentration is a double-edged sword. It always is. To put it simply, the thing that looks like dominance is also structural fragility. Second, the flywheel is cyclical, not perpetual. The buyback engine runs on trading fees, and fees dry up when volume dries up. So we have to look at the actual numbers. Buybacks fell from 316.76 million in Q3 2025 to 192.25 million in Q1 2026. That's a meaningful decline. In a deep, quiet bear market, that deflationary engine loses steam at exactly the moment we'd want it firing its hardest. Third, the supply overhang. Hype has a monthly unlock cadence for core contributors, and each tranche is roughly 9.9 million tokens. The June 6 unlock was worth around $565 million. So here's the math. At current fee levels, the buyback only retires 1/6 of each monthly unlock. So even with the most aggressive buyback engine in crypto, the float is still expanding. The market has absorbed this so far, with over 85% of one earlier unlock immediately staked rather than dumped. But it cannot be waved away. Fourth, the regulators have arrived. On May 21st, 2026, the UK's Financial Conduct Authority added Hyperliquid and the Hyper Foundation to its warning list as unauthorized firms. The FCA told UK consumers to avoid dealing with the platform, warning there's no access to the financial ombudsman or the compensation scheme if anything goes wrong. But it doesn't allege fraud, to be clear. Some high-profile industry voices summed up the mood, praising the innovation while noting the platform would need strong legal cover. And some analysts have warned the FCA action could be the first of many regulatory moves against the platform. Hyperliquid also isn't available to US or Ontario users, and rivals like CME and ICE have actively lobbied US regulators to scrutinize it. All in all, the exact same fact is simultaneously the strongest bull case and the sharpest bear case for Hype. The consolidation of flow into one venue is what makes the buyback flywheel so powerful, but at the same time, the consolidation of flow into one venue is what makes the entire system a single point of failure. You cannot have one without the other. The strength is the fragility. Both things are true at once. So the value capture is real, the cash flows are real, 3 spot Hype ETFs are real. Bitwise's B-Hype, 21 shares T-Hype, and Grayscale's Hype G have already pulled in over $220 million since launching in May. And the concentration risk is real. The unlock pressure is real, and the regulatory clock is ticking. So what do you actually watch from here? Let me give you the scoreboard. First, watch the concentration number itself. If trade XYZ's 97% share starts dropping because genuine competitors emerge, that's healthy decentralization. If it stays at 97% or climbs higher, the single point of failure risk gets worse, not better, no matter how bullish the price action looks. Second, watch the buyback versus unlock ratio. Right now, the buyback retires 1/6 of each monthly unlock. So if trading volume climbs and that ratio improves, the deflation thesis strengthens. If volume fades and the float keeps ballooning, that's a warning signal. Third, keep a close eye on the regulators. The FCA was the first. If a second tier 1 regulator follows, the pressure to adopt restrictive, less DeFi native controls becomes very real. And fourth, watch the next big listing. The space expert proved these markets offer genuine price discovery the traditional world simply can't. So the next pre-IPO blockbuster will tell us whether that was a one-off or a repeatable engine. So here's the question I want to leave you with. Is Hyperliquid's winner-take-all consolidation the moment crypto finally produces a real cash flow generating venue that captures global flow and rewards its token holders for actual usage structurally bullish? Or is 97% of an entire ecosystem sitting inside one app fed by expanding supply and circled by regulators a fragility so deep that the first real crack takes the whole thing down, structurally terrifying? Because the next year of crypto will reward only the venues with real flow. So please watch where the volume goes, not where the hype is. Pun intended. I genuinely want to know where you land on this one, so please get properly opinionated in the comments below. I'll read as many as I can. And if you want to understand how these permissionless venues are quietly rewiring the entire structure of crypto trading, definitely check out our deep dive right over here. Thank you all so much for watching, and I'll see you again very soon. This is DC, signing